The Call is brought to you by CMC Markets, a world-leading online trading platform for CFDs and shares around the globe.
Hi everyone, welcome back to ausbiz. We kick off the afternoon live from our Barangaroo studios with The Call, 10 stocks picked by you. I put them to two experts. We do it in 1 hour. Wednesday, the 26th of October. Why I am racing is because I want to introduce our panel. We've got so much to get through. Carl Capolingua from ThinkMarkets. Afternoon, Carl, Michael Wayne from Medallion Financial. All right, first up, before we get into anything, market sharply down after the inflation figure came out a bit higher than expected, 1.8% for the quarter. Market's expecting 1.6%. Carl, do you worry about that for the market?
No, I think the market's done pretty well. You know, we've come off the highs. Look, the market's in a different phase, I think, now. So I think it depends. Look, a lot of it's going to depend on the US. Kind of long story short, there's a bit of a rally on there. So I'm talking more in technicals, Koshi. I'm not talking as much in big picture stuff. Yeah. You know where I'm going with this, right? Yeah. So I think there's a bit of a rally going on. Look, today's CPI data is a bit of a setback in terms of the price action, but I think we're going to get dragged a little bit higher. Just based on what's happening with US earnings season, just a bit of fund flow stuff, a bit of anticipation the Fed's going to back away a little bit, and I think there's a bit more. Okay. Then the whole reality of the broken global financial system, in so many ways, is going to set in at some stage, and down we're going to go again.
Okay, all right, Michael, does the inflation figure worry you?
It doesn't so much worry me, but it'll be interesting to see how the RBA reacts. Obviously, it's getting pretty hot out there with inflation now catching up to the US figure almost. So it'll be interesting to see whether they start to revisit 0.5% interest rate increases again. But I think they might wait for it. The problem in Australia is this only comes out once a quarter. Yeah. It doesn't come out monthly like the RBA. So it'll be interesting to see if they want to wait.
Actually, trialing.
Sorry, Michael, they're trialing the monthly.
Oh, they are. Yeah. New monthly series.
There you go.
But faith in it yet, but it's interesting that they've done. Yeah. Because we were quite the laughing stock, weren't we, of the entire Western financial system. Philip Lowe got up at a conference and he mentioned, our data's only quarterly, and all the bankers in the room laughed at him. So the ABS snapped to attention.
No, so they should. Hey, the first 5 stocks we're going to look at this half hour: Sierra Resources, Rio Tinto, Regis Healthcare, Virgin Money and Woodside. But first, budget came out last night. So, and I quizzed the treasurer this morning about his slush fund that he's got tucked away. And that is, he focuses on all the spending and all that sort of stuff. But tucked away in the assumptions on the income side is that coal and iron ore are in the budget with an assumption iron ore falling to $55 a tonne. Well, not falling, that's what the income is based on. It's $130 a tonne for metallurgical coal at the moment. They reckon the budget assumption is $60 a tonne. And for thermal coal, which is about $500 a tonne, they reckon 60 as well. So Carl, will iron ore and coal get down to the budget assumptions? What's the chart tell you on iron ore? Will iron ore get down to $55 a tonne before the end of June?
Yeah, it's at 3 years, I think, is the usual cycle, or the outlook, I think, isn't it? For the budget? I think
he's doing it for the next year. The assumption is $55 a tonne.
Well, I reckon. Yeah, it depends on. I mean, I think Treasury uses 3 years. Maybe, obviously, what the treasurer uses is his business, isn't it? Really. But you're $55 in the next 12 months. I'm not so sure. Look, it could get there. I mean, look at that chart. So we're looking at the far right. This is the weekly chart of iron ore going back to 2010. That's all the data I could pull. But yeah, look, I mean, if it breaks through that low there at 90, there's every chance the next level there's probably around 80. I mean, that's my expectation. So I've been working off $80 for a very long time now, and I've been stepping that down. Obviously, viewers 6 months ago would have heard me say 100. Before that, they would have heard me say 120. But I think 80 is pretty sensible, right? Given what's going on in the world. But hey, if we do end up in a really bad breakage / global recession, then 55 is that scenario. So that's post-GFC, right? They're post-GFC prices, which was
Yep.
probably an overshoot from that cycle. But I think what viewers need to take away here is that there is a cycle, isn't there? You go from a period of significant underinvestment in commodity X. Now, by commodity X, I mean insert your commodity here: lithium, natural gas, whatever it is, coal, right?
Yeah.
And nobody wants to do it, and then all of a sudden the world needs a whole heap of it. Prices go through the roof, and then everybody wants to find it and dig it out of the ground. The market is flooded by supply, and the price turns the other way. And probably along the way, there's some sort of global recession to exacerbate, to produce that overshoot to the downside.
Right.
And then we just go through the cycle again. That's human nature, unfortunately.
Okay, so you think 55 for iron ore is realistic if we go into
I don't think it's
global
out.
recession?
I don't think it's. Yeah, I think it's in the ballpark. In the worst case scenario.
Yeah, iron ore can be pretty volatile. It can move pretty quickly.
God, we should be selling all our iron ore stocks now.
Well, it
And
can
well
be
out
very.
of them by now.
If you look at BHP, it was $45 and it went down to 15, then back up. So they can be quite cyclical. You look at the stockpiling and the inventory levels in China, and it's down 25% from a year ago.
Yep.
The housing market, property market, construction market still remains tenuous. So it is possible. I don't necessarily think it will get there, but it's definitely possible.
So what's your floor?
And I don't know. Okay. But basically, you look at the Liberal Party did the same thing. They always pretty much.
Yeah, Treasury
had
always.
Treasury, always.
And that's what I said to Jim Chalmers. I said, you've got your slush fund. And he said, well, Treasury has always been. I said, I know, you've had this slush fund forever, and it makes you politicians look good because, coming around like this year, $30 billion fall in the budget deficit that was predicted because you fudged the figures.
It shows how reliant they are on.
They've got to take credit for that, don't they?
Oh, yeah. Okay, what about coal? Coking coal and thermal coal, Carl, down to $60. That's the budget assumption.
I've said so. Coking coal down to 60.
Yep.
Doesn't look. No, I don't think that's realistic at all.
No.
I mean, that's just silly. That's stupid.
Right.
No, don't look at that chart.
Yeah.
Even if you go look at the long-term averages, I mean, you've got to go 5 years ago. And the thing is, I mean, we all know the narrative. We love the narrative on this show, and I'm one of the coal bulls. You know that is that there's not as much investment in coal to sustain.
To bring supply.
Or to bring, exactly, supply down to where it was 5 years ago. So, demand with a war going on in Europe is.
There's thermal we've just brought up.
What is it? That one?
At $60.
No, that's silly. Look, it'll come down, no doubt about it, but it's not in the next 12 months. That's absurd.
Yeah. So the difference, Michael, on coal as well. Do you think it'll come down at $60?
No,
metallurgical
no chance. I mean, coking coal's got more chance of coming down further than thermal, I think.
Yeah. So that gap is the slush fund.
Yeah.
That the government works on.
And they're very reliant on coal and iron ore and mining, very evidently.
Exactly. The two biggest exports, they bodged up the income figures.
Yeah.
You've got a sorry, Kosh, you've got a bunch of coal mines underwater now as well.
Yeah.
So.
Yeah, which is pushing the price up even further. Okay. All right. Just wanted to check with the experts because I did have a discussion with the Treasurer about, we're being conservative. I said, there's a difference between being conservative and rigging the books. And this is so silly. It's like rigging the books. Okay. Thank you for that. Appreciate all your charts and your comments on it. And I did say, I've got a bottle of red wine. How about a bottle of red that it will never reach those assumptions? And his answer was, I'm off the Reds at the moment. I went, how convenient.
Very political excuse.
All right, let's get into the stocks that you want us to take a look at. But thank you to you both for your comments on those, on iron ore and coal. First up, Sam wants a view on Sierra Resources, Carl, the mining and exploration group. All the revenue from a graphite mine in Mozambique.
Yeah, so far, So this, it's such an interesting story. I've talked about Sierra a few times on the show. It's been like my bonus buy. I've tweeted about it. It's a ripper. I mean, stick with it. If you're on it, stick with it. It's such a bottom left, top right sort of chart there, isn't it, Koshi? And the reason why it looks so good on the chart, and this is the other thing, like don't look at a chart like that and say, oh, I've missed it. It's too late. I can't buy it now. It's gone up too much. I mean, these are the exact charts I'm looking for, right? So I'm looking for the opposite of you. I want to say everybody is frothing at the mouth to get in. Now, hey, I know somebody's going to shout at me and say, hey, Carl, eventually they all crash. Oh, look, yeah, they do, but I'm not going to be around when they crash. I'll be out way before, right? So I want to be in them on when they're heading up, and this is what this is doing. So they have a graphite mine in Mozambique. I'm pretty sure it is. I haven't looked at this one for a little while, but off the top of my head, it is. Yep. And they're mining there. Mining there since 3 or 4 years of production. Not that it's going all that great. They're having some significant industrial relations problems at the moment. The last time I checked, costs are heading up. Diesel, just labour, that sort of stuff. Usual thing that all mining companies are experiencing. But I think why that's not impacting the price, of course, is people looking past that to the incredible vertically integrated, battery anode monster that this thing could be. Okay, so it's being funded by the DOE, the Department of Energy in the US. They've given them a bunch of money to get into production. That production is due third quarter 2023. There's sort of 11,000 kiloton per annum of anode material. They've got binding offtake agreements. So here we go, Tesla. I think pretty sure that one's binding. I think non-binding with Ford. They're still doing assessing the product quality of the product and the usability of the product. And then I want to say LG also. So what we've got here is they're mining it, they're turning it into anodes, and then they're selling that to the battery industry. From the mine, they will also sell to other anode manufacturers as well. So it's all blue sky sort of stuff, Koshi. But having said that, if you look at some of the broker consensus numbers on this, we're talking about 15 times FY24 earnings, which sounds super cheap for the growth that's in this. So I reckon there's a little tear in the space-time continuum here, Koshi. I'm a buy. I'm a buy on this one. If you wait for a pullback, wait for a pullback. But I think you want to have some of this. You want to have some skin in the game here.
Okay, Michael?
Yeah, it's an interesting business. Basically, one of the biggest graphite producers outside of China, looking to become vertically integrated, the biggest outside of China again. They've recently signed up some funding, which basically enables them to get another project off the ground. The big issue that's been surrounding the company recently has been that illegal strike action in Mozambique, which has brought their mine to a halt. So they do have a little bit of geopolitical risk, that there's no two ways about it. The mine life, though, in Mozambique is 50 years, so it's obviously a very big deposit. And so far they seem to be ticking all the boxes in terms of the progress towards their stated aim of being that integrated supplier. So graphite is a very, very large component in batteries, more so than a lot of the other things that get spoken about. Yep. So that long-term runway for growth makes a lot of sense. Just to throw out another one, there is an Australian-based graphite producer called Renascor, which is market cap of 500 mil. It's obviously not as developed or as far down the line in terms of production and building that integrated network, but they are trying to do something similar. I think they found a site in South Australia as well, which they're going to do a lot of the processing at. So that's a more speculative one for people to keep an eye on. Right. But it is a space that we are...
Less sovereign risk.
Less sovereign risk, but probably higher risk in terms of production.
Yeah, cool.
And just less advanced and less mature. But we don't mind Syra, SYR. And we don't mind this other one as well, Renascor.
What do you think of Renascor, Carl? Have you?
It looks half decent on the chart. I mean, it's like we keep talking about lithium, isn't it? Go for the ones that are trying to get to production, or the ones that are in production. It's always that old argument. But some other stats. The reason why I like it, again, you can wait for a pullback. I think if you can get it closer to $2, you're fine. So you don't have to rush out today and get it. But I think you want to have some at some stage. But we're looking at Chinese anode. Demand. So demand for anode material has doubled every year for the last 3 years, right? You've got battery production in the US up tenfold in the next 5 years, and then doubling in the next 5 years after that. So I think you're at the thin end of the wedge. Not trying to make the batteries and all the vagaries of that. They're not trying to make the EVs and all the vagaries of that. They're just selling graphite. It's awesome. It's a great model, I think.
Yep. All right, Jason Michael wants a view in Rio. Jason says, how does the experts rate them against other iron ore exporters? It's interesting, Rio's been having a lot to say recently, saying it's asking for pitches for some of the from some of the biggest investment banks to buy lithium companies. It wants to get into lithium. Then it's warned of a global commodity market slowdown because of recessions in Europe and the US. And then its new chairman has flagged an overhaul of the board because they're saying they're not aggressive enough. So a bit about Rio recently.
Yeah, they're probably a bit tentative in their sort of capital expenditure and the large-scale acquisitions, given what took place last mining boom.
Yeah.
They've been a lot more constrained recently, and to some extent it has limited their rate of growth, but they are a very high-quality iron ore producer. That's primarily what they produce. They do have some copper and aluminium. They sold their coal assets, which they're probably regretting at the moment, in about 2018. But they've got good mine life, low cost of production. I think they might even have lower cost of production on iron ore than BHP. So it's a very good quality company. Recently they came out with a slight production cut from what the market was expecting. Their costs have remained pretty steady, and they should benefit as well from the decline in the Aussie dollar, which should enable them to keep those costs in US dollars pretty stable. So look, it is a quality exposure to iron ore, but you have to go back to the chart that we were looking at the beginning of the show in understanding that iron ore is very, very cyclical. And because of Rio's reliance on iron ore, the share price of Rio tends to be very cyclical as well. Yeah. So I am a little bit conscious and cautious when looking at iron ore, just because of the whole China story and what's been playing out over there. But from a long-term time horizon, if you wanted that broad exposure,
2-year low.
Yeah, I mean, it's not trending too well either. We don't have clients in Rio. We have a few clients in BHP, but Rio's not on our list.
Would
so
you get into Rio now?
No, I'm going to have to give it a sell, just looking at the chart, and just given where we are in that iron ore cycle, I am cautious that things might continue to fall away in that space.
Carl, what do you think of Rio? And by the sound of it, they're hinting that they, obviously with iron ore prices coming down, they want to diversify into some other metals now too.
Yeah, that makes sense, doesn't it? I mean, the other big trick for Rio is copper, obviously, and the copper price doesn't look great either. So, you know, they're spot on. They're warning about global recession, and if these guys can see it coming, given the access to, you know, the customer base that they have globally, then I think investors or viewers listening today should really take some warning about that, and probably the Treasury should too, right? So they know, they've got the ear close to the ground, so they can see the bottom left, top right charts like Syrah that we've just talked about in EVs, and they want to have a bigger piece of it, and I think that makes sense. But there's the oldest argument in the book, Koshi, of, well, are they going to buy at the top of the cycle? And, you know, BHP has been the most acquisitive, let's face it, historically. And it's worked out well for them. It hasn't at other times. So I don't think you go, well, buying at the top of the cycle hasn't worked before. I think you've got to be sensible, because quote unquote this time could be different. So I don't mind them looking into lithium, but I just don't like the fact that they're still such massively dependent on iron ore, and I'm bearish on iron ore prices. The question was, look, which iron ore stock? I think that was the question. The question was, well, there's three major ones, obviously, BHP, Fortescue, Rio, and I'm with Michael. I don't like either of them. Maybe just Koshi, see which one donated the most to Telethon over here in WA, and that would tell you who's the best to invest in. But by the way, Koshi, I should mention your performance there is Michael Hutchins. Viewers who haven't seen it should Google that. And I tell you what, if you want to see bottom left, top right sort of stuff, getting pulses racing, and we're going to talk about Regis Healthcare in a second. I reckon a few pulses at Regis across the nation got racing, Koshi, watching you in that skin tight outfit. I reckon. What
amongst Regis customers who are senior Australians? Thanks very much.
They would have.
Yeah, good on you. All right, I'm not sure how to take that. I think that was a bit of a backhanded compliment. So no for Rio. You'd say sell for Rio. But would you same with BHP?
Same. I'm sell on all iron ore stocks. I've been a sell for over 6 months now.
Yep. Okay. All right. Let's talk about Regis then. Michael provides residential care for elderly Australians. Whole bunch of facilities on the big, largely dependent on government funding with aged care facilities, and that got a big lift in the budget last night.
That's true, but it is a difficult space to operate in, despite that natural tailwind that's there with the ageing population. And it's one of those sectors that draws a lot of attention from investors because they think it should make sense over time.
It's a good thematic.
It's a great thematic, but
except when you have a Royal Commission.
It's highly regulated, and the problem is you have the Royal Commission, all of a sudden a lot of the requirements that need to be met by these aged care facilities are tightened. So you need more headcount, for instance.
So costs go up.
Costs go up, and costs have already been going up because of COVID for these healthcare operators. Absenteeism is a huge one. They're also struggling getting staff.
Yep.
Regis has seen a pickup in occupancies again. A lot of people were reluctant to go into aged care homes when COVID was rampant or out and about in the community because they were worried about catching it from other residents and being locked in and so on and so forth. But there are tentative signs that that's started to improve a little bit and people are willing to come back into aged care facilities. Management didn't provide guidance for FY23, and that's because there's probably a lot going on at the moment with the business, just trying to understand what are the lasting effects of COVID. Are staff going to come back to work, and are we going to be able to access international staff? So they have been a little bit cautious on their costs and forecasting their costs. So from mine, I just think these businesses overall tend to be very complex. Margins tend to be quite narrow, and it tends to be a bit of a moving feast when it comes to government regulations. So from mine, I'm going to go a sell.
Carl, what do you think of Regis?
Yeah, Michael, it's spot on. He's really nailed, I think, all of the key points on this one. It is such a complex area, and you probably need to, I'm not saying Michael isn't an expert, I'm not saying I'm an expert, you're probably better off taking advice from somebody who is an expert in this complex area of health, aged healthcare more specifically. So I'm going to just go to a different level and just talk about the financials, I think, because that's something I do think I am an expert on. And just to give you as an idea of where this sits for financials. So the money they earn and how they're priced in the market. So they earned 1.3 cents per share in FY22, and obviously because of the disaster that the pandemic was for them, that was 4.5 cents the year before, it was 7 cents the year before that, it was 15 cents the year before that. But I would put to you that their earnings were declining into the pandemic anyway. Now they are going to bounce back as things improve and get back to normal, but their earnings in 4 years' time are still going to be less than their earnings were 4 years ago. And that's not the sort of business I want to be in, to be honest. I don't think they're at all cheap. So you're looking at paying around about 22 times next year's earnings, 20 times a year. It just, with the growth that they have, the risks that are in the business, from a pure valuation standpoint, I do not believe the valuation is compelling, and the chart doesn't look great either. So I'm with Michael, I'm a sell.
Okay. All right. Next stock on the agenda today is Virgin Money. And Michael, Todd wants a view on Virgin Money. Of course, it was spun out of National Australia Bank. It's a Clydesdale Bank, Yorkshire Bank in the United Kingdom. So getting exposure to UK banks rather than Australian banks.
Yeah, that's right. So Clydesdale spun out of NAB. Clydesdale actually bought Virgin Money, and then they changed the name to Virgin Money. The one thing it's got going for it is it's cheap relative to its peers.
Right.
However,
is that a good thing?
That's the one positive. The fact is, they've got a big reliance on their credit card book, which was meant to be high quality. Right. They've started to see some weakness there and bad debts picking up in that part of their business. You look at their net interest margins, which actually slightly fell in this environment where a lot of their peers in the recent update, and this is UK banks, saw an uplift in net interest margins. So I just struggle to see why an Australian investor will really want exposure to something like this.
The UK is going into a serious recession,
and that's the big thing.
And we're not.
And they've been focusing a lot on like unsecured type debt, such as credit cards, and it's very difficult. And it's hard to forecast what's going to happen there, but you wouldn't think it's going to be too pretty. But as I said, they are relatively cheap compared to their peers. They're trading on, I think, a P of about 5 times earnings, which is low. But you would have to think that leading into the UK recession, this could be in a little bit of not trouble in terms of going belly up, but you could start to see bad debt spike. And it's not like they're making huge net interest margins to compensate for that. So I'm going to go sell.
Carl? Oh, hang on. I think you might be on mute, Carl.
Sorry.
There you go.
Am I back? Yeah, sorry about that. It's a little bit of noise out the window here. I was just saying Michael's nailed it again, because viewers will look at a stock and they go, oh, the PE's, what is it now? 3. I mean, the PE's 3. And I go, oh, that's cheap. But the market isn't, the market knows this. It's not a surprise. If you bumped into 10 fund managers on your way to work this morning and you said, hey, did you know Virgin UK's PE is 3? It's really cheap. All 10 of those fund managers are going to say, I know it's there. It's don't worry, it's the right price. It's priced exactly where it should be. We know, we're aware. Right. That's why we're not buying it, and that's why my buddy who had it, he's got a sell order on, and it's been going for 6 months, and it's just working through the market. But none of us other guys are buying it, so that's why the stock's going down. There's no free lunches in the markets, and I don't think you've got one here. Okay. I'm a sell as well. The chart looks horrible.
Okay. All right. Come out. Is this a free lunch at Woodside? Carl, do you reckon? Mark wants to know.
I love the way you're putting that. Look, there is going to be a major supply deficit, I believe, based upon the research I'm reading. But you tend to read stuff that appeals to you, don't you, Koshi? If I'm a uranium bull, I like to read bullish stuff on uranium. I don't read any of the bearish stuff. I'm bullish on coal. I'm bullish on natural gas. So I try not to read any of the bearish stuff. But there is going to be a substantial deficit, I believe, in natural gas for all the same reasons we've talked about. Energy security, transition to renewables, not going as quickly as possible, and the fact we just need to keep warm. So I like Woodside from that perspective. I do believe it has a place in your longer-term self-managed super fund style portfolios. The chart would back it up, so no objections from the chart. It's still very much bottom left, top right. Operationally, Woodside has been such an I don't know if it's over-promise, under-deliver is the right thing. I think just under-deliver from whatever they promise. It's sort of getting the last sort of 12 months, 18 months, we're getting to the point now where they're starting to actually over-deliver a little bit. So I kind of like that too. So operationally, they're heading in the right direction. I do think there's great scope for 80% of their business is natural gas. The chart is bottom left, top right. So it goes 3 ticks for me. I'm a buy.
Yep. Michael?
It's the preeminent sort of hydrocarbons business in Australia, top 10 globally. The recent sort of merger with BHP's energy assets, I think, has been good for the business, allowed them to reduce debt significantly. They're now undergeared, arguably, compared to where they've been historically, and it's probably worked out well given how far interest rates have gone up. There were concerns around their cash flows, but they have cut back their capital expenditure. They recently upgraded their production forecasts. The amount of gas that's going out to mainly Asia for them is significant. They really do dominate that space. Only about 20% of the gas that Woodside produces goes into the domestic market. Santos is about 40%, and something like Beach is probably about 60%. And that's probably in their favour at the moment, given we know some of the supply constraints that are occurring in energy globally. Our preference is actually for Santos on a valuation basis, but we do have clients that hold both. We just think that Santos's free cash flow generation in the years to come will allow it to have a bit more upside than Woodside from here. But Woodside's assets are low cost. They're in the bottom quartile of production costs globally. And there's a lot to like about the company now that it's merged with the BHP assets, because it has increased their growth profile significantly, and the available options they've got to expand production going forwards increased as well. So I'm happy to give it a buy, but we do have a preference for Santos, which we also have a buy, obviously.
All right, let's recap the first 5 stocks. Our commodities of the day, but just temperature checking the federal budget last night that has a forward $5 a tonne price for iron ore in the budget for over the next 12 months, and $60 for coal. Carl and Michael, see 55 as maybe realistic sometime in the future for iron ore, although Carl thinks it will only get down to about 80, similar to Michael, but it's heading down. And the $60 a tonne assumption for thermal and metallurgical coal, both Carl and Michael think are crazy, and that's where the slush fund in the government budget actually comes from. Syrah Resources, a buy from both Michael and Carl. The graphite group, Reniscore, is a local one that Michael likes as well. They've got a sell on Rio, a sell on Regis, a sell on Virgin, Both of them like Woodside, but Michael has a preference for Santos if there's a toss-up between the two of them. So a couple of buys from both with Syrah and Woodside in that half hour. Here on the call, we're tracking our own high conviction growth fantasy fund, which is picked by the investment committee. You can see the October committee meeting, which is a couple of weeks ago, on the platform, ausbiz.com at the moment. Let's check to see what they decided at that meeting. They removed Ardent Leisure. Babcorp was trimmed. They increased their stake in Washington Soul Pattinson, and Incitec Pivot was trimmed. SEEK was added with its weighting funded by the Ardent Leisure sale and the trimming of Incitec Pivot. Let's see how the portfolio is going. Since the 1st of March, it's up about 2.25%. So keep sending in your requests for the call, because that's the first filter that goes up to the committee. So today, Syrah Resources, and I think Woodside's already in the portfolio at the moment, but Syrah Resources will go up to be adjudicated by the committee to see if it will go into the portfolio. This half hour, we're going to run the ruler over Macquarie, the ASX, Helios, Credit Corp and Bell Financial. Michael, Simon wants a view on Macquarie Bank.
Yeah, so look, Macquarie comes up quite often on the call. We spoke about it, I think, a few weeks ago. We have a long-term sort of buy on it. It is obviously a long way off its highs. It's a very high-quality business, a lot more diversified than it used to be, and less reliant on the market gyrations and cycles that we're seeing at the moment. But to break it down to a granular level, their commodities business is doing quite well, as you would imagine in this environment with the dislocation that we've been seeing in the commodities space. The big question is also going to be whether they can maintain their momentum in the mortgage market. They've really sort of emerged as a big player in the Australian mortgage market, but there's going to be, over the next few years, almost 20-25% of that market come up for grabs as many people leave fixed term mortgages that roll over and become flexible rates. So there's lots of competition potentially on that side of things. They are very competitive at the moment with some of their refinancing rates in order to win market share there. One positive for them, having a lot of funds under management or assets under management in US dollars, has been the falling Aussie dollar has cushioned the blow, so to speak, when it comes to some of the declines in their funds under management in their asset management part of the business. However, it's not an ideal environment for someone like Macquarie. Transactional volumes are low, investment banking volumes are quite low as well. But when you take a long-term view, these sorts of opportunities historically have presented a good chance to buy. Carl's definitely going to turn around and say the chart looks terrible, but I think if you're taking a 3 to 5 year view, you should be okay. But in the short term, it could continue to go lower, particularly if markets come under pressure.
Okay. So what are you saying? I'm
going to do a long-term buy.
Long-term buy, okay. Carl?
Yeah, I mean, in the, it's like the long-term estimates for coking coal and iron ore, isn't it? No, I think, yeah, look, I am going to say sell on this one because I'm more concerned about. So, I mean, Michael painted, he said the good start, there's some good stuff in there, and then some, like some concerning stuff, some risks. And I'm, you know, we talked about how I'm looking at a lot of the energy commodities at the moment, and I look at it with one eye, saying it's bullish. And people, this is the great thing about the market, right? You look at something with your own view, and then you go and transact in the market. You become part of supply and demand, so it's all good. But I know I'm a sell here because I'm more concerned about the risk. And we know that Macquarie, just go look at the cycles. It's all cycles. Macquarie does well in bull markets, right? When the bull starts to turn to bear, their chart starts going down, and it goes down until the bear starts to turn to bull again. And I think we're still in the bear phase, so that's why I'm worried about Macquarie. Always, when clients do ask about Macquarie, I say, hey, look, I know it's quality, I get that, but don't forget, GFC was trading around 100, it fell to 15, right? Now, of course, it's down 140, so if you take that really long-term view, yeah, okay, you can hold past the valley, but that's not my style. I don't want to be in it for the valley, so I am still selling this one. I think you will get it significantly cheaper if the you-know-what hits the fan.
Yeah, and you're a different sort of investor because you're an active investor, aren't you? Sort of
that
for
people
a lot
need
of,
to understand that,
yeah, for their self-managed super fund that say, okay, I want a long-term exposure to a bank. They don't want to trade in and out all the time.
Yeah, if you're going to look at your portfolio once a year when you get your annual statement, then ignore everything I have to say. If you're more active and you're looking at your portfolio every couple of weeks, that's where I fit in, I think.
Right, yep. All right, Simon wants a view, Carl, on the ASX, the company that runs the platform, share platform for all of the trading, that is sort of tries to constantly change with technology. It takes a bit longer than most people think.
It does, doesn't it? Yeah.
What do you think of the ASX?
Yeah, look, I cannot remember a time where they've delivered something on time and it didn't break on the first day. Goshy. So, they've had some pretty bad launches, let's face it, but maybe that's all behind them. And we digress. We shouldn't pin that on them as whether it's been there for good investment or a bad investment, because for me, at the end of the day, it comes back to financials, which aren't heading in a great direction. So a lot of their trading volumes are starting to slow, and that will tend to happen. What we find, we have a weekly meeting over here at ThinkMarkets, and the sales guys will go through, they'll talk about, okay, what are the clients doing? And for the last few weeks, it's really been about clients that just aren't doing anything anymore, right? They're just sitting in cash. I mean, I've been telling them to go to cash for many, many months now, right? But and it doesn't help. It doesn't help ThinkMarkets either, by the way. The fact I keep telling our clients it doesn't help. Like, it's not good for us at all, right? But so if our clients are a reflection on the broader, stockbroking environment, then it just means lower transaction values, and that's not what ASX likes. They clip the ticket. Every time you trade, they clip the ticket. And the other thing is, when markets go like this, and many viewers will know that, love their small cap stocks as well, like the volumes just go straight out of that. There's just nothing really happens. So yeah, I'm a bit more concerned. I'm putting that concerned hat on this one. The valuation is not compelling, so sometimes I can get past some of those concerns if it just looks dirt cheap. And this one doesn't. It's trading at about 25 times this year's earnings, with a compound annual growth rate over the next 4 years of 4%. Right. That is astronomically high. If you've got earnings growth of 4%, your PE should be 10 at most. So I think this is significantly overvalued. The chart looks horrible, which I think reflects a lot of my concerns. I'm going to go sell.
Yeah, 3.5-year low, Michael.
Yeah, look, it would be tempting for a lot of people, because a lot of people like this business. It's a quality company, quite a dominant player, obviously, for a number of reasons, and it's been a steady dividend payer, often with a increasing dividend per share year after year. But this environment's not very good for it. Let's put it that way. The secondary market, that's buying and selling shares sort of on a daily basis, has been under pressure. There's no two ways about it. It only makes up about 5-6% of their overall revenue. A big chunk actually comes from the primary listings market. That's IPOs and that sort of thing.
Oh, right. Yep.
And that's dried up a lot. The futures market's another big thing for them, which has been pretty stable. But as Carl points out, the forecast growth rate of about 4-5% per annum for the next few years compares to a 10 to 12% increase in expenses that they announced in the recent updates. So their margins are getting compressed. They do claim to be somewhat of a tech business, and they are kind of competing in that tech space for workers, and they've seen a lot of inflation in their wages within the business as well. Their dividends, they pay out 90% payout ratio. It's not like they're going out and investing a lot in growth, so you can be pretty confident you'll get a pretty decent dividend. But as Carl points out, they're not cheap, they're not growing that quickly, and the dividend per share is unlikely to keep growing at a good rate. And the dividend yield's not even that attractive at these prices. Right. So you've almost got to treat it like a bit of a bond proxy, because a lot of people are in there for the dividend, and as bond yields have gone up, it's no longer as attractive as it was. So for mine, I'm going to go with a sell.
Okay. All right. Paul wants a view on Helios, Michael, our second biggest pathology provider, third largest diagnostic imaging provider here in Australia. 70% of its revenue comes from pathology, the rest from diagnostic imaging. They're a big beneficiary of COVID testing in car parks around Australia. Charged the government, or charged us, a lot of money for doing it.
That's it. But those days look like they're coming to an end. You see the average daily testings dropping significantly. I think they're about sort of 5,000-6,000 a day. They're expected to fall and then flatline at about 3,000 a day, and I think be lucky if that's even the case. So they will be winding up a lot of those testing clinics and testing centres. That will create a lot of one-off costs for them. But if you strip out all the COVID stuff, the business is performing okay, growing about 5%. Right. Their imaging business has picked up a lot as people return and feel confident going back into hospitals and getting all those tests and images done. The business for a long time there was paying a lot of money on rents, being in sort of suburban and regional clinics. They've decided to leave a lot of those clinics and move back into the core hospitals because they had a lot of cost inflation, but their revenues weren't growing that much. Right. Often their revenues are somewhat capped by government as well, and what private health insurance can increase their premiums by, etc. So it's a business where your revenues tend to be somewhat capped and your costs can quickly get away from you. So it's not the best quality business in our view. We think Sonic Healthcare is probably a preferable play if you're going to go down that path. We're not in Sonic Healthcare, but we have looked at it at times in the past. But for us, Healius is a sell. They're going to lose, well, their earnings are going to go back a long way because of the wrapping up of the COVID tests, or at least the decline in the COVID testing. And it'll be interesting to see what's left with the business after that. Right. So not the worst business on the market, but definitely not in our top 50 or 100.
I'll tell you what, when I was in the queue in the car, getting to, they ran our local one, which was in the car park of our local surf life saving club. And it was just a marquee, and there's a line of people all getting stuff up their nose. And I was thinking, the margins on this must be enormous, because the rent on a marquee wouldn't be that high in a car park. Yeah. And they just had 4 people there, sort of
just churning them out.
They made huge amounts of money, didn't they? Carl, what do you think of Healius?
In short, I agree with everything Michael said. So I'm a sell, but I'm just looking through my charts of the healthcare sector. So I've got a watch list, which is just healthcare. Because I think viewers want a healthcare stock, right? And that makes sense. But I don't think this is the one for everything, all the reasons you said. So just not on the valuation. I'll give you just a little bit of insight. So this year they earned 52 cents a share. By FY26, that'll be 22 cents a share. Okay, let that sink in a little bit. 52 cents down to 22 cents. I mean, their earnings are going to more than halve. It's just not something I'm interested in. So this is not the one. Last time I was on, I covered this. I called it a sell. I said buy ResMed instead. I'm still with ResMed. I still think that's good. Just looking down the list here of charts. There's companies I like and valuations I like, but they're not matching with the charts. Promedicus is one where I think the chart is half decent. There's a little biotech called Neuron, NEU. I think that looks pretty good as well. And only got down to the R's. I didn't, so I can't. I'll get to the end of the list another time maybe.
That's right. But you like ResMed. ResMed came up yesterday, and Mark Morland preferred Fisher and Paykel.
But Mark and I are very. I've known Mark for probably about 15 years, and we've done many things together. But we're just very different styles. He's more deep value. I'm more trend. So Fisher and Paykel it's going the wrong way. So that would be a sell for me.
Okay. We like both ResMed and Fisher and Paykel, but they are quite different businesses really, and they get bundled together a lot. Yeah. ResMed's the sleep apnea machines. Fisher and Paykel gets a small chunk of revenue from sleep apnea devices, but the majority of their earnings are from what do they call it? Like respiratory cure, respiratory like plastic masks and ventilators and all that sort of stuff you get in hospital, which is more the consumables, wear it once, throw it out type thing.
Right. Okay.
Fish Paykel's come back a long way, but we like both of them.
Okay. All right. Michael Craig wants a view on Credit Corp, the consumer debt market buys loan books from financial organisations and collects all the money and keeps clips a ticket on the way through. What do you think of Credit Corp?
We have clients in Credit Corp. It's been an okay performer over the long term, not so much in recent years, in the last 12 months. Had a decent update yesterday in that it reiterated its guidance for the year, but it also talked up the outlook. And you have to understand, for a business like this, it's as much about being able to replenish your book into the future with new purchases. Half the job is picking, or a lot of the job is picking quality purchases to buy and then chase up the debt. So they'll often buy these debts which are 90, 120 days in arrear. They'll buy them for X amount in the dollar, often a big discount because companies are just happy to get them off their books, and they'll chase it up, and their recovery rates will be whatever they are, 70, 80, 90%. They'll make a big spread. The problem in the recent years since COVID is there's been a lot of handouts from government to people, so people haven't really been falling into arrears on a lot of payments and a lot of debts. But that's about to change as people run down their savings and the handouts stop and the economy potentially goes into recession. And Credit Corp actually thinks that's a good thing because it means there'll be more supply of these arrears books to buy, which means they'll be able to pick off better quality ones.
And they'll get a better margin.
And they'll get a better margin, where in recent years it's pretty slim pickings in terms of what's become available.
So this is a good recession stock?
It's not in the GFC, it didn't do so well. But I think if it's just a typical recession rather than a very deep thing, it can actually go quite well because it sets up their earnings quite nicely for the years to come. The market has a tendency to penalise it during downturns because it thinks that people won't be able to pay back their debts, so Credit Corp won't be able to collect as much. But they've proven in the past that's not necessarily the case. But the purchases that they do now will set them up for earnings growth in the next couple of years. It's hard to call it a buy at the moment just because of the negative momentum we're seeing in the share price, but long term I think it's proven itself to be a good quality business. So for now I'm going to give it a hold. But it is a business that we like, and it's been a proven performer over a long period of time.
Carl, what do you think of Credit Corp?
Yeah, look, I agree. I mean, I've talked about today some stocks that are ridiculously overvalued. ASX is probably the most overvalued one. Healy's is not great. But this one I think is fair value. I think it's about the right price, but I can't get excited about it. Just the chart obviously is very bad. It's top left, bottom right. But I agree with the risk of a really substantial downturn in the economy comes opportunity for this one. But I think Michael mentioned the most important thing there, which is just how the market treats it and how the market prices it. And just on that basis, I think if you look at that chart you had before, we saw what happened during the pandemic, right? I mean, that's when the fear was, okay, well, the quality of credit is going to go into the toilet. And that didn't happen, but it's a longer term chart than that one. But if you go back to GFC, I mean, the stock was $13 and then just huge plunges as the world unraveled, which was a credit crisis, obviously. And then it went down to, $13 to 40 cents, over the space of about 12 months. I'm not saying it's going to happen again, but I'm just saying if things get really bad, that is how the market that's the lens through which the market will view this one. So I think you need to be a bit careful.
Apart from
so if you have it,
apart from that pandemic drop down, it's almost at a 5-year low.
Well, let me have a look. It is. Apart from that, probably 2018 would be the lowest point for it. But again, it's like Macquarie Bank. It does well in the better parts of the cycle. I get this idea that they can reset a lot of their book after things are bad, because that's when people want to offload risk and bad credit. I get that, but I don't think we're at that stage of the cycle yet.
So not for you.
It's still a sell. No, it's still a sell.
All right. And our final stock, Carl Financial, the stockbroker investment financial advisory group in Australia, in New York, London, Hong Kong, and Kuala Lumpur. What do you think of Bell Financial?
I'm going to go. I must admit, I'm rushing today. Plus, I had to go to the. I went to the World Cup match, Australia versus Sri Lanka last night, so I didn't get to the end on this one. Apologies, right? Didn't have time. Started late today, the late night. So I didn't look at the fundamentals on this one. I apologise, but so I can only do the chart. Just me being upfront with the viewers, because normally I'll due diligence on everything. The chart looks terrible. I think that probably summarises everything. And a little anecdote here, nothing more than an anecdote. I just told you what's happening at ThinkMarkets, right? Clients are pulling their heads into their shells and they are just waiting for this stuff to blow over. A lot of people think there's still a big leg down and they're going to get stuff a lot cheaper. And just in terms of volumes for your plain old vanilla stockbrokers, I'm sure these guys do other things, but that would, I think, verify the state of the chart. So I would have to say sell.
Okay. So do you think there's going to be another big leg down?
I am in that camp, yes, Koshy, very much so.
Right.
I think it's inevitable.
What sort of timing?
Inevitable. I think we need to get past that. At the moment, we're getting a little bit of a bounce because they think the Fed is going to slow down. Yeah. But I do think the Fed still has to get rates, the cash rate up to at least above where inflation is. You've got so much debt out there now, and that's fine when your rates are at zero, but it's not fine when your rates are at 6-7%. And then mixing not just the private sector debt, but government debt, you've got dislocations and breakages in a number of small simmering little hotspots within the financial services system that threaten to explode into the broader financial system, much like it did in 2008. And I hope I'm wrong, don't get me wrong, but I just think the balance of risks means you need to maintain high cash levels at this point in time.
Right, okay, because we're seeing a bounce on sort of the thesis here on a call with a lot of the experts is that yes, the temperature of the market is pretty good at the moment. Maybe get a Santa rally that we traditionally get into Christmas, but next year they're all really cautious about come back from Christmas and nothing to look forward to.
Yeah, look, again, I work for a stockbroker. It's not good business to say don't invest right now, but I've got a duty of care to my clients.
Yeah. All right, Michael, what do you think of Bell Financial?
Look, we're basically a little micro company similar to Bell Potter.
Yeah.
And like ThinkMarkets, it's been a very tough 6-12 months. In the case of Bell Financial, they're a bit more diversified than someone like myself. They're almost like a full-service stockbroker, a net wealth, and a ComSec all in one, where they've got like the discount trading platform through Bell Direct. They've got their sort of platform, reporting platform type thing as well through something called Fusion. Then they've got the stockbroking business. Daily transactional volumes for them are down, the brokerage numbers down. A big part for Bell Potter is their small mid-cap IPOs, and that part of the market's dried up completely. So they're very cyclical businesses. When times are good, it's very, very good. But when times are tough, it's better to be an advisor in one of those businesses than to be the owner, because there's a lot of fixed costs, a lot of technology, a lot of research costs. Staff costs are very, very high as well for these companies. I'm almost a believer that many of these sort of service type companies, whether it be a law firm or accounting firm, stockbroker, they're better off being unlisted just because they tend to be very cyclical businesses. They tend to be good dividend payers, but tend to be quite volatile. And the market doesn't like that typically, the public markets anyway. The dividend per share was very good last year. So the dividend yield for the company at the moment looks very, very high, but they have to cut their last dividend payment by about 40%. It's likely the next payment will be 40% lower than last year. So you have to just understand very cyclical businesses, and they jump around with market sentiment. At the moment, the sentiment's pretty negative. So I'm going to give it a sell.
Okay. And your thoughts on another leg down?
Yeah, that's the way we're positioned. We just struggle to see how everything will automatically all of a sudden repair itself. We expect the volatility can continue. We think that bear market rallies like what we saw in sort of June, July, August are likely, where you get these 10-15% recoveries before things come under pressure again.
And October's been good so far.
Well, that's right. And those sorts of bear market rallies are very, very normal. Until we start to see corporate earnings come off and interest rates peak, I think it's very hard for the market to rally. And for now, I just think the status quo will continue, where we get these moments of optimism followed by moments of despair. And I think today's inflation number for Australia is a perfect example for that. We always, for the last 6 months, everyone's been talking about how far behind Australia is to the US, and the inflation problem isn't so bad here, and all of a sudden you're sort of brought into the real world and reality strikes. So I just think that news flow will continue to drive the narrative.
Okay, all right. Carl Capolingua from ThinkMarkets, always great to have you aboard, and thanks for bringing the Aussies home in the T20 game last night. Good to see you. And also Michael Wayne from Medallion Financial. Good to see you, mate.
Thanks, Koshy. Good to be here.
Let's recap the final 5 stocks. Macquarie, a sell from Carl, a long-term buy from Michael, a sell from both on the ASX, a sell from both on Helios. Michael prefers Sonic, and in that healthcare space, Carl prefers ResMed or Pro Medicus. Credit Corp a sell from Carl, a hold from Michael, and Bell Financial a sell from both. Coming up on the small caps next, it is one of the biggest listings on the ASX this year. Conrad Asia Energy is listing tomorrow, and company director Mario Traviati joins us next on the small caps to take us through it. If you'd like any stocks for us to cover here on the call, put them in an email, thecall@ausbiz.com.au, or tweet us using the Ausbiz TV handle. And a reminder, you can see all the stocks in the Calls Fantasy portfolio at ausbiz.co/portfolio. Stick around, we have small caps coming up next.
The Call is brought to you by CMC Markets, a world-leading online trading platform for CFDs and shares around the globe.